Hello and welcome to Outlook Money's Investment Made Easy podcast series. The series is spearheaded by ICICI Prudential Asset Management Limited. I'm Mihika Shah from Outlook Money and your host for this session. First of all, Outlook Money wishes a very happy new year to all of its listeners. We hope this new year brings wealth, success, and good health with it. Happy New Year to you too, sir.
Yeah, Mihika, Happy New Year to you and all the listeners of Outlook Money. Like you mentioned, health is of utmost important and wishing every listener great health and hopefully with some value addition that we do over these calls, a long way to create the wealth as well. Thank you so much.
Thank you. The topic of today's episode is how ETFs can be used for trading and investing. ETFs are ideal for beginner investors due to their many benefits such as low expense ratios, abundant liquidity, range of investment choices, diversification, low investment threshold, and so on. In the previous episode, we discussed about ETFs and how it is different from stocks. In this episode, Mr. Chintan Haria, Head, Product Development and Strategy, ICICI Prudential AMC, will tell us how ETFs can be used for trading and investing. Welcome, sir, to this episode.
Hi, Mika. Thank you so much.
Starting off with the very first question, sir, could you help our listeners understand how trading is different from investing?
Sure. So, if we look at what is the meaning of trading versus investing, in trading, you would basically invest in a ETF and then expect that the ETF would go up in the next 1 month, 2 month, 3 month, and then expect to book profits. So trading essentially is an activity wherein you're buying and selling at intervals which are short intervals, maybe in 3 months, 4 months, 5 months, 6 months. It could be as low as 2 days, 3 days as well. So I think trading as a style is something which we all know, looks very good, keeps you engaged, but empirical evidence in the long run has shown that trading on account of taxation, on account of transaction costs, on account of the amount of mental bandwidth that it requires, is something which very few people are successful in. It gives you the adrenaline high that you invest, or you rather make a purchase today and in 3 days' time it goes up and you sell. But you probably end up missing the trees for the wood in terms of missing out the bigger picture and the bigger gain that stock markets and ETFs provide to you. Investing, on the other hand, is considered as a way of holding on to your purchases for the long run. Investing would mean buying today and probably holding on for a year, 2 years, 3 years, 4 years without actually selling your investment, without actually trading away your investment. In other words, investing is a way of buying and forgetting, wherein then whatever you've bought allows you to keep compounding for the long run without you having to actually see it day in and day out. Now, the fun in investing or the thrill in investing may probably not be that much because you will find it boring that I've bought and then I'm sleeping over it for 3, 4, 5, 6 years. I'm not doing anything. But that's how probably a bulk of money gets made in markets. It is said that the bulk of the money is made in the waiting, not in the doing. In other words, you buying, selling, trading may not really work for you. But if you wait with your investments for the long run, assuming that the investments in terms of entry price and in terms of the underlying construct are good, your long term orientation and investing will help you create wealth. And that's what we all are here for, right? We all are here to create long term wealth without seeing the leakages of taxation on short term capital gains or without seeing the mental bandwidth being held in trading. So, trading is a very laborious, mentally straining job, which probably not everyone is cut out for, and hence few people succeed in trading. But most people, if they're investors and they're genuine long-term investors, they will benefit out of investing. Thank you.
Okay, sir. Can ETFs be used as trading instruments?
Yes, pretty much as you're aware, ETFs are traded on the stock exchange at real-time NAVs. So You can buy an ETF today, and in 3 days' time, 4 days' time, you can trade it out, or in 3 months' time, 4 months' time, you can trade it out, assuming that your objective is achieved. Just as an example, if you believe that, okay, commodities can have an uptick and you buy a commodities ETF today, for example, and after 3 months the commodities ETFs does do well and you sell it out. So you are able to trade in ETFs, but like I mentioned in the previous question, trading in ETFs again is a specialized skill. You need to probably have the experience, the understanding before you basically achieve the desired goals in terms of trading in ETFs. Is it possible to trade in ETFs? The answer is yes. But does it require a lot of energy, skill, experience? The answer is yes. So if you're trained to do it, if you have experience, you can go ahead and trade in ETFs, and there are enough options available. For example, today not only we have ETFs on large cap, mid cap, small cap, but we also have in the industry ETFs on sectors like infrastructure, commodities, banking, healthcare, technology. So there are various options which an investor has across themes. Then there are momentum ETF, there are low vol ETF. So there are long-term orientation also, and then there is option of trading these ETFs also. What fits you and what view you have, you can actually trade through the ETF routes also. In fact, when you trade through the ETF route, let's say for example you want to believe that next 3 months will be good for technology, and instead of buying one technology share where can be an individual technology share risk because something can go wrong with that individual's technology stock, if you pick up the entire basket of technology through the technology ETF or the IT ETF as it is called, you will end up having the benefit of diversifying into many stocks in a single instrument, and you will get the benefit of trading the entire basket of tech stocks. So your objective of trading will also be achieved, and the objective of diversification through ETF will also be achieved. So reducing the risk and then allowing your participation in the tech sector based on your view is possible, and hence trading in ETF is pretty much possible. But like I said, it requires experience, it requires you to have the skill, and it requires you to probably spend a lot of your time also on looking at the markets continuously. Thank you.
Definitely. So what kind of investors should consider investing or trading in ETFs?
So I think from a availability of options within the ETF space, like I mentioned, there are market cap based ETFs, large cap, mid cap, small cap. There are sectoral ETFs across sectors. There are smart beta ETFs like low vol alpha, low vol momentum, NV20, etc. There's gold and silver ETF also for those who want commodity exposure. Then there is within debt also there's liquid ETF. There is other options available within debt ETF. International investing is also possible through ETF. So I think an investor can create an entire portfolio out of ETFs, and that's what makes ETFs a good tool to provide a low cost creation of an overall portfolio. And I think from an investor standpoint, be it a new investor or a beginner, be it an investor who is sophisticated or has experience in markets for many years, all, be it a small investor, large investor, an investor who's just starting the journey, an investor who has a lot of money and probably has already a lot of portfolio stocks, everyone can participate in ETFs because there is diversity in terms of the offerings within ETFs, and within sectors and asset classes also. You have enough opportunities. So pretty much any investor, based on their asset allocation, based on their risk profile, will find a suitable ETF or a set of ETFs to fill in their bouquet of products in which they're invested. Thank you.
Coming to my next question, how much of an investor's portfolio should be allocated to ETFs?
So I think that question will be best answered from person to person. But what generally can be seen is that a large part of an investor's portfolio, overall portfolio in financial assets, would be in dynamic asset allocation bucket. That's the right way to go because you get the good allocation between equity and debt and gold if you're in asset allocation schemes. Apart from that, which have underlying which are active, or it can have underlying which are passive also. So you can have the a large part of an investor's financial assets in passive multi-asset fund of fund kind of funds which are investing in across equity, Indian equity, Indian debt, international ETFs, and gold. Apart from that, you do have, you know, 20-30% which you could possibly want in directional ETFs, which could be sectoral, thematic, smart beta. So there's no limit as such to how much an investor can have in ETFs as percentage of the overall portfolio. You can be as high as 100% also. But general rule of thumb, which we see in India, where most large investors are gravitating towards, is that 70 to 75% will be in active assets or active funds, and maybe 25 to 30 would be in passive funds, which includes gold, silver, international investing, etc. So I think a 70-30 mix between active and passive is what most investors are gravitating towards as such, those who understand ETFs. But there is no specific recipe as to how much ETFs. You can have all your money in ETFs also. There is no restriction because ultimately you will get the benefit of low cost, long term participation in the markets across all the asset classes which are available within ETFs in India. Thank you.
Typically, the performance of ETFs relies on the performance of a particular sector. How can investors capture emerging trends in these sectors?
Sure. So if we look at what your question is basically building in, that there are times where certain sectors do extremely well. So if you have a sector or a thematic ETF, you can take advantage of that. For example, in the last 2 years or 2.5 years, infrastructure in India has done exceedingly well as a sector. So if you are invested in infrastructure as a ETF, you would have probably taken the advantage of that, or you would have got the advantage of that. Technology for the last 4 years, except for the last 6 months or so, did well. So 2018 February to March 2022, technology as a sector probably did exceedingly well. So you could have taken advantage of the sectoral performance doing well. Now, when you say that ETFs typically are helped by some sectors doing well, so if you have a diversified ETF, like say the Nifty 50 or Sensex 30, then at different points of time, different sectors will do well and you'll keep participating in that. But generally, uh, in diversified ETFs, you do get the advantage of diversification, which is what they are supposed to do. So no single sector will have a very meaningful impact on the long-term performance of a diversified ETF. All the sectors at different cycles of market will perform. For example, in the last 6 years, if we look at the broader indices, there were times when tech did exceedingly well, but metals did very badly. Then 2020 to 2022, metals did exceedingly well, oil and gas did exceedingly well. At that time, actually, probably something like pharma went for a downturn. So 2022, maybe pharma didn't do well, but metals, etc., did exceedingly well. So in a diversified ETF, which has all the sectors as part of it, or has most of the leading sectors as part of this, let's say the top 50 names in the market, top 100 names in the market, you will find some sector doing better than some sectors. So it's like a combination of 3-4 sectors which do well under certain market conditions. Then the other sectors start participating when the earlier sectors don't do that well. But in the long run, all of them contribute towards the growth of the portfolio. However, in themes and in sectors which are narrower, like I mentioned, infra as a theme, commodities as a theme, um, technology as a sector, pharma as a sector, banking as a sector, you can potentially have those sectors do exceedingly well in certain time periods, which will help you get the kicker. For example, in the last 7-8 months, banking has done exceedingly well. So banking index or banking ETF, if you had in your portfolio, you would have got the advantage of that. So to generalize the statement that ETFs, or diversified ETF typically will have a sector which will pull it up in the long run, that may not be correct. But then there are certain sectoral ETFs which at different points of time do well. And if an investor is well informed and makes a experienced decision, they can get the benefit of the sector doing well. For example, autos in the last 1 year, 1.5 year, have done phenomenally well. So if you had auto ETF in your portfolio, you would have ended up getting the benefit of that. So in the next 2 years also, if you expect auto to do well, then maybe you can look at adding auto ETF to your portfolio. So it all depends. Again, it all boils down to the investor's ability to pick the right ETFs and then move on and create the portfolio in a manner that on a risk adjusted basis, the investor ends up benefiting from the overall exposure to ETFs. Thank you so much.
Definitely, sir. My next question to you is investors are allowed to invest in multiple of stocks from a single stock to many. What is the minimum amount one can invest in ETFs?
Okay, so if we look at the way ETFs are trading, just going down to the basics, while I know all of you all know what ETFs actually do. What are ETFs? ETFs are essentially mutual funds which have their units trading on the stock exchange. Mutual funds, by definition, will have methodology and predefined, let's say, universe and selection methodology, which will allow you to know beforehand what exactly does the ETF do. Banking ETF will have banking, technology ETF will have technology, Nifty 50 will have the 50 names of Nifty in the weightage that there is in the Nifty. Sensex 30 will have Sensex 30 stocks. So you exactly know what you're getting in the ETF. That's basically the structure. And the ETF is basically the mutual fund at the back end, which basically replicates whatever is the methodology, the universe, and the underlying stocks. Now, that units which you own in the mutual fund, and much like a single stock, that way it is traded in single unit, an ETF can also be traded via single unit. So, just to give an example, if there is a BSE 500 ETF, all the 500 names are part of the mutual fund underlying. And the single unit of that, which could be about 150 rupees, 200 rupees, whatever the case might be, will allow you to get exposure in all the 500 names in that proportion. So a single unit of BSC 500 ETF, or a single unit of technology ETF, a single unit of banking ETF, a single unit of Nifty, so anywhere between 50 rupees to 100 rupees to 150 rupees, depending on the price of that single unit of the ETF on the exchange, you will be able to buy. So I think from an Indian context, an investor can buy a diversified portfolio with as low as one unit of that underlying ETF. And that one unit typically is anywhere in the range of 35, 40 rupees to 100, 200 rupees, depending on the basket size, depending on the lot size, depending on what the index is and the multiplier of the index or the divisor of the index. So to put it very simply, ETF is a very easy way to you to start participating in diversified funds, in sectoral funds, which will have probably 15, 20, 30, in 500 constituents with as low as maybe 50 rupees, 100 rupees, 150 rupees, depending on the trading price of the ETF on the exchange. So it is basically democratizing and making it easy for all investors who have a demat account to start participating, even if your savings are not that significant and you are able to invest with as low as 50 rupees, 100 rupees, 150 rupees, depending on the price of the ETF on the exchange, the price of the underlying ETF, whichever you are basically choosing on the exchange. Thank you so much.
So, my very last question to you for this episode is what would be your advice for people who consider ETFs as trading instrument rather investing one?
So if we look at, as we mentioned, and it's like a full circle, the first question also was similar in terms of can the ETF be used for trading and investing? What is the meaning of investing and trading? I explained in the first question. Much like that, ETFs can also be used for trading and investing, as I had explained. But I would like to reiterate and keep reiterating for all our listeners that trading is a specialized skill. It will absorb you 100% of your time, and maybe you will not be able to focus on your profession or job uh, as much as you should if you get into the habit of trading. However, investing is that much easier in terms of its long term orientation. Once you have the right set of asset allocation and you've picked up the right set of funds, which can be advised to you by your advisor, you will be able to peacefully hold on to it for the long run and get the advantage of compounding, which with the growth of economy, the underlying equity assets would do. Equity assets being very volatile. In the short run, there are so many market events. There can be plane crashes, there can be terrorist attacks, there can be change in governments, there can be many of these events which are unknown, unforeseen, and can happen and impact you in the short run. But if you look at the long run, if you look at 5 years, 10 years, the markets ultimately prevail in terms of the earning capacity, the profitability growth, and that reflects in the stock prices. So in the short run, it becomes very difficult to predict the direction of the market. In the long run, it's that much easier. You will not know the extent of the direction of the market in terms of how much money will you make. But in general, if you have a 10-year, 15-year, 20-year belief in India's growth story, you will end up getting the benefit of that through the compounding that happens. The compounding does not happen in a straight line, and hence, from an investor standpoint, trading is extremely difficult because you don't know which bad news. I mean, something happens in US markets are down 3-4%, it will have an impact on the Indian market tomorrow. So I can't predict tomorrow, but 5 years, 10 years down the line, can I predict that India will be a bigger nation, our GDP will be bigger, profitable will be bigger, and hence your investments can potentially be bigger as well? The answer is yes. So between investing and trading, always pick up investing. Trade only if you are an expert and if you probably spent enough years and experience in trading. ETFs allow you to do both, but I would say stick to investing to the extent that most successful investors in the long run have been those who are investors and not traders. Uh, it's not to say that you can't make money out of trading, but yes, if it's your profession and your job is not equity markets predominantly, stick to investing via ETFs rather than trading via ETFs. You can do both, but I would stick to investing. Thank you so much. I think it's been a very interesting session, and we've covered a whole range of topics and look forward to our next session with the Outlook Money Group. And I thank Outlook Money for allowing us this opportunity. Thank you. Thanks, Mika.
Thank you so much, Mr. Haria, for joining us today. Our listeners will surely benefit from the insights and details discussed in this episode. With this, we come to an end of today's episode of Investment Made Easy podcast. Listeners, we hope you have enjoyed our conversation today. Please don't forget to share your comments and feedback. You can also share your suggestions and questions at editor@outlookmoney.com. We will be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money, your favorite personal finance magazine. Thank you.